Judicial uncertainty in the markets refers to the situation when the legal rules and institutions that govern economic transactions are unclear, unpredictable, or subject to frequent changes. This can create challenges and risks for businesses, investors, and consumers who rely on the judiciary to enforce contracts, protect property rights, and resolve disputes. Judicial uncertainty can affect the economic outlook of different regions and sectors in various ways. For example, it can reduce the confidence and trust in the legal system, which can discourage investment, innovation, and entrepreneurship. It can also increase the costs and delays of doing business, which can reduce efficiency and competitiveness. Moreover, it can create opportunities for corruption, rent-seeking, and litigation abuse, which can undermine the rule of law and social welfare. Some examples of judicial uncertainty in the markets are the debt ceiling debate in the U.S., which could lead to a default on the government's obligations if Congress fails to raise the borrowing limit. This could have severe consequences for the U.S. economy and financial markets, as well as global stability. One possible outcome is that the White House could invoke the 14th Amendment to bypass Congress and avoid default, but this could trigger a legal challenge and create more uncertainty. The judicial overhaul in Israel, which aims to reform the appointment and oversight of judges and limit the power of the Supreme Court. This has sparked controversy and criticism from legal experts, civil society groups, and international organizations who fear that it could undermine judicial independence and democracy. The prolonged uncertainty over this issue could damage Israel's tech ecosystem, which depends on a stable and predictable legal environment to attract investors and entrepreneurs. The Brexit process in the UK, which has involved complex and contentious legal issues such as the Withdrawal Agreement, the Northern Ireland Protocol, and the future trade relationship with the EU. The lack of clarity and consensus on these issues has created challenges and risks for businesses and consumers who operate across borders or rely on EU regulations. The Brexit uncertainty could also affect the UK's judicial cooperation with other countries on matters such as criminal justice, human rights, and data protection. The judicial uncertainty in the markets refers to the legal challenges and disputes that have arisen from the pandemic and its economic consequences, such as lockdowns, stimulus measures, trade disruptions, debt defaults, and vaccine patents. These issues have created risks and uncertainties for businesses, consumers, and investors, affecting their decisions and expectations. The ECB, BOE and Fed have reacted to the judicial uncertainty in different ways, depending on their mandates, inflation targets, and economic conditions. Let's analyze how their policy actions have affected inflation, growth, and employment in their respective regions. The ECB has maintained a dovish stance throughout the pandemic, keeping its policy interest rate at zero and expanding its asset purchase programs to support the recovery and inflation. The ECB has an inflation target of below, but close to, 2%, which it has undershot for most of the past decade. The ECB is less tolerant of inflation going above the target than the BOE or the Fed, and has emphasized that the current inflation spike is temporary and driven by supply shocks and energy prices. The ECB has also stressed that the pandemic is still weighing on consumer and business confidence, and that it needs to maintain flexibility and optionality in its policy stance. The ECB's policy actions have helped to cushion the economic impact of the pandemic and boost growth and employment, but they have also faced legal challenges from some member states' courts over their compatibility with EU law. The BOE has taken a more hawkish approach recently, becoming the first G7 economy to hike interest rates since the onset of the pandemic. In December, the BOE raised its policy interest rate to 0.25% from 0.1%, citing the need to contain inflation expectations and meet its 2% inflation target sustainably. The BOE expects inflation to peak at 6% in April 2022, 3 times its target level, due to supply disruptions, global demand imbalances, and energy prices. The BOE has also signaled that further rate hikes are likely in 2022, as it anticipates a strong recovery in growth and employment. The BOE's policy actions have reflected its concern about the inflationary pressures in the UK economy, which have been exacerbated by Brexit-related trade frictions and labor shortages. The BOE has also faced legal challenges from some groups over its involvement in financing the government's fiscal stimulus during the pandemic. The Fed has also shifted to a more hawkish stance recently, signaling plans to tighten monetary policy, and the Fed announced in November 2021 that it would taper its asset purchases by $15 billion per month until they end in March. The Fed also indicated that it would raise its policy interest rate 3 times in 2022, starting from near zero, as it expects inflation to remain elevated and growth and employment to remain strong. The Fed has a dual mandate of maximum employment and price stability, and it has adopted a flexible average inflation targeting framework that allows it to tolerate inflation above its 2% target for some time after periods of below-target inflation. The Fed has attributed the current inflation surge to supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. The Fed's policy actions have aimed to balance its dual objectives and respond to the changing economic conditions. The Fed has also faced legal challenges from some states over its emergency lending programs during the pandemic. In summary, the ECB, BOE and Fed have reacted differently to the judicial uncertainty in the markets, depending on their mandates, inflation targets, and economic situations. Their policy actions have had different implications for inflation, growth, and employment in their regions. While they all hope that the supply bottlenecks will ease over time and that inflation will return to their targets, they also face risks and uncertainties from the pandemic, geopolitical events, and legal disputes. In this section, we will discuss what the ECB, BOE, and Fed are expected to do in the near future and how their decisions will impact the market sentiment and performance. The ECB, BOE, and Fed are the central banks of the Eurozone, the United Kingdom, and the United States respectively. They are responsible for setting monetary policy to achieve their objectives of price stability, economic growth, and financial stability. They use various tools to influence the interest rates, money supply, and credit conditions in their economies. However, these central banks face different challenges and opportunities as they navigate the recovery from the COVID-19 pandemic and deal with the surge in inflation that has been driven by supply bottlenecks, higher energy prices, and strong demand. They also have to consider the potential effects of the fast-spreading Omicron variant of the coronavirus on the global economy and their own regions. The ECB has been more cautious than the BOE and the Fed in withdrawing its stimulus measures. In December 2021, the ECB announced that it would cut its monthly bond purchases under its Pandemic Emergency Purchase Program, PPP, from €60 billion to €30 billion until March 2022, when the program is due to end. However, it also said that it would increase its regular Asset Purchase Program, AP, from €20 billion to €40 billion per month from April 2022 onwards. The ECB also kept its main refinancing rate unchanged at 0% and its deposit rate unchanged at -0.5%. The ECB President Christine Lagarde emphasized that the pandemic was still weighing on consumer and business confidence, and that the ECB needed to maintain flexibility and optionality by withdrawing support step by step, but not committing to a full exit from pandemic support programs. The BOE surprised the markets by raising its benchmark bank rate from 0.1% to 0.25% in December 2021, becoming the first G7 economy to hike interest rates since the onset of the pandemic. The BOE said that inflation was set to hit 6% in April 2022, 3 times its target level of 2%, and that some modest tightening of monetary policy was likely to be necessary to meet its inflation target sustainably. The BOE also reduced its target stock of government bond purchases from £875 billion to £845 billion, effectively ending its quantitative easing program. The BOE acknowledged that there were two-sided risks around the inflation outlook in the medium term and that the Omicron variant posed a downside risk to growth. The Fed also signaled a more hawkish stance in December 2021, as it committed to end its pandemic bond buying program by March 2022 and laid out an accelerated timetable for interest rate increases. The Fed said that it would reduce its monthly asset purchases by $30 billion per month until they reach zero in March 2022, doubling the pace of tapering that it started in November. The Fed also raised its median projection for the federal funds rate from 0.1% at the end of 2021 to 0.9% at the end of 2022, implying 3 rate hikes next year. The Fed Chair Jerome Powell said that the U.S. was heading towards strong growth and full employment in 2022 and that the Fed needed to treat inflation as the more pressing risk. These divergent policy paths reflect the different economic conditions and inflation pressures faced by each central bank. They also have implications for the market sentiment and performance in each region and globally. Generally speaking, tighter monetary policy tends to dampen economic activity and asset prices, while looser monetary policy tends to stimulate them. However, other factors such as fiscal policy, exchange rates, trade flows, and investor expectations also play a role. In this context, we can expect that the Eurozone will benefit from continued monetary support from the ECB, which could boost consumer spending, business investment, and exports. However, the Eurozone also faces downside risks from potential further lockdowns due to Omicron, political uncertainty in some countries such as France and Germany, and structural challenges such as low productivity growth and high debt levels. The UK will face some headwinds from higher interest rates and lower bond purchases by the BOE, which could weigh on consumer borrowing, housing market activity, and government spending. However, the UK could also benefit from stronger external demand as its main trading partners recover from the pandemic, as well as from improved business confidence following the resolution of some Brexit-related issues. The US will experience some moderation in growth and inflation as the Fed tightens its monetary policy stance, which could reduce consumer spending, business investment, and stock market valuations. However, the US could also maintain its momentum as it has a more advanced vaccination program, a large fiscal stimulus package, and a resilient labor market. Therefore, we can conclude that while each central bank has its own rationale for adjusting its monetary policy stance in response to the judicial uncertainty in the markets, their decisions will have significant effects on their own economies as well as on global financial conditions and trade flows.